Hello everyone and welcome to episode 11 of Ask Mortgage Mike, where I take topics and questions that have been posed to me regarding the mortgage industry and try to educate you, the viewer, on how those rules pertain to you. So today, obviously, everyone's seen on the news all about Brexit. So today we're going to talk about Brexit, interest rates, and you and how they affect you. So the first and foremost, everybody knows kind of what's happened with Brexit and them leaving the European Union. So today we're going to talk about how that's affected interest rates and how you can track the interest rates as a public without having to actually pay for subscription. So the only thing that dictates interest rates for conforming loan products are going to be the mortgage-backed securities. Well, mortgage-backed securities, unless you track them on a daily, if you want to track them on a daily basis, you would have to pay for a subscription to an MBS service to track those. As far as for what you can do on a daily basis to track them and see how how interest rates are doing, you can track the yield on the 10-year Treasury note. So what happens is a 10-year Treasury note, and the way this works is if people are putting money in the 10-year Treasury note, then what happens is it's a supply and demand. So as more demand goes into putting money into the securities of a 10-year security note, then what happens is the yield or the interest rate returned to you, the investor, reduces. So what happens is when we see turmoil in the stock market and the world market, what happens is the tendency is for people to put their money into a safety net or a security blanket such as a security or a treasury note. So the 10-year treasury note is what you can track, and you want to look at the yield of that. So as the market starts tanking, people put their money in these long-term securities, or 10-year treasury yield is what you would want to track. As the demand for putting money in that safety blanket goes up, then the government says, well, since so many people want to put the money in, we're going to pay you a lower yield, a lower return on your investment. Now, then as the confidence comes back and people start pulling money out of the treasury, then they start putting money into stocks and back into the market and other commodities. So then once that demand goes down, then the federal government comes out and says, well, what we're going to have to do is if we want to spark the interest of people still putting money into the treasury bonds, then we're going to have to raise the return, the yield that we're paying to the investor. So the way that this affects you is if the 10-year treasury yield is going down, which it has been, that's where people are putting money and the yield is going down, that generally means that interest rates are going down also. And as the 10-year treasury yield goes up, then the interest rates generally go up. So if you wake up in the morning, you see the 10-year treasury yield at 1.50, and the next day you wake up and it's 1.55, then that means that interest rates today are worse than where they were yesterday, and vice versa. If you wake up and they were 150 when you wake up, 1.50 on the yield, and then the next day they're at 1.45, then that would mean that interest rates have gotten better the previous day. So I hope this helps explain how you can track interest rates and how they pertain to you specifically. Again, this was episode 11 of Ask Mortgage Mike. If you have any questions at all, feel free to email me at askmortgagemike@gmail.com. I hope everyone has a great week, and I'll talk to you later. Bye-bye.